to me, the goal never was and never will be to have a complete real estate portfolio. It's to have a wealth position that's diversified across a number of assets that can sustain and endure for a lifetime and maybe even multiple generations. And for that, there's diversification. The ultimate diversification is a stock market index fund because you own a piece of every public company in the United States of America. That's the beauty of real estate. It's an inflation-adjusted income stream for life.
This is your Real Estate Syndication Show. I'm your host, Whitney Sewell. Today, we interview the CEO and president of BiggerPockets. I'm grateful for his time. His name is Scott Trench. I think he has a very interesting seat to see into so many aspects of real estate investing and so many people and investors across the industry, right? And he is going to bring that today. He brings a ton of information around syndication and things they are learning, even some big things they're doing at BiggerPockets that are going to help you, the passive investor, and I think operators as well. They're going to help the cream to rise to the top. That's for sure. And that's definitely what he's going to focus on in the show too. And it's helping you, the passive investor, to know those operators that you need to be investing with, and even the deals through the current economic cycle that maybe you need to be steering away from or you should be interested in. He's a graduate of Vanderbilt with degrees in economics, history, corporate strategy, and finance. He has been at BP as he was the third employee, actually employed by BiggerPockets, and he's been there ever since. Became the CEO in 2018. And he's authored best-selling book, Set for Life, which I highly encourage you to check out, to read, especially for maybe people that are getting started thinking about investing or newly married or something like that. I love the frugality piece that he stresses and emergency reserves, things like that are, we think are common sense, but often more times than not, unfortunately, are not done. So I love this, even some things that came out towards the end of the episode around how he strategizes with his wife. And I appreciated that in a big way, his focus there and the importance that he places on that as well. I know you're going to learn a lot from Scott today. Scott, welcome to the show. Honored to have you on and get to know you a little bit.
Whitney, thank you so much for having me today.
Yeah, grateful for your time. And I'm looking forward to just drawing from your insights as CEO of BiggerPockets. And you've been there, I think, since 2018 or so as CEO, and was their third employee as well. And so just you have a ton of insight into the real estate market. I think being in that seat, and I want to learn from you. I want the listeners to be able to learn from you today. I know we are going to learn a lot. So again, thank you. There's going to be a number of things that are going to come up. I know, just so the listeners know that we're going to talk about real estate. I want to get your opinion about the economy and the market, things like that, because I get that question all the time. And I know everybody wants to know, what's he think about the market? What's he think? What should I do? Right. But I want to get to that. I want to jump in a little bit to maybe who you are individually, personally, and your just outlook on investing as it sits at the moment, like your portfolio, some insight into how you invest and what's important to you. I know, and I want us to jump into syndication in a big way, because I know that just as you shared that, you all just done a ton of research around that at BiggerPockets, and I want to glean from that as well. So, but first, what's investing look like for Scott right now? And I know the listeners have heard of your book, Set for Life, and some of that, which I highly recommend. But what does that look like for you right now, your portfolio and investing?
Sure. Yeah. So I have four major asset types in my portfolio. The first is boring, old-fashioned stock market index funds. And I've put most of the capital I've accumulated in my life into those stock market index funds. The second big one is real estate, residential real estate, duplexes, triplexes, and quadplexes here in Denver, Colorado. I have about the same amount of wealth in those rental properties, but I put a lot less cash into them, thanks to the leverage and appreciation in Denver in the last 10 years as I've been on my investing journey. And the third bucket is going to be in real estate debt. So I have a couple of hard money loans that I've purchased from hard money lenders. I haven't gone the whole hog and actually originated them and papered them on my own there, but I have purchased them from hard money lenders. And I like the simple interest that they generate. and for my portfolio. The last big bucket is I'm a big investor in a private company called BiggerPockets.
Can't imagine why that last one's in there. You mentioned, and I know a lot of people have questions. Well, wait a minute, the big focus on index funds, right? Why is that? And give us some insight there.
I lead BiggerPockets, and I'm a huge fan of real estate investing. But to me, the goal had never was and never will be to have a complete real estate portfolio. It's to have a wealth position that's diversified across a number of asset classes that can sustain and endure for a lifetime and maybe even multiple generations. And for that, there's diversification. The ultimate diversification is a stock market index fund because you own a piece of every public company in the United States of America. My real estate portfolio is a major wealth producer, and I think will perform really well over a long period of time, but it is a very heavily concentrated bet in Denver, Colorado, on real estate. And while I am very bullish on that, I don't put all of my eggs in the Denver, Colorado residential real estate basket. I plan to put many of them in there, but not all of them.
Love that. Love the focus on diversification as well, and just the sustainability, by doing that. Speak to, do you have a certain, say percentage of your net worth or wealth that you're wanting to keep in index funds versus real estate or even the debt piece, or, how do you look at some of that?
Yeah. So, and like, this is where my philosophy evolves over time, right? So a year and a half ago, I was really fearful of the market. And so I thought, okay, what's the lower risk way to play this? Well, it's in debt, right? And I put money into hard money loans. This is great in theory, 12 to 13% blended interest rate. But I'm also, in a relatively high income tax bracket. So after taxes, that return looks more like 6 or 7%. After a year or two, I've really kind of evolved my thinking of like, well, what am I doing with these like private notes here? Like if I'm in a high tax bracket and I'm fortunate or arrogant enough to believe that I'm going to continue to be in a high income tax bracket for a long period of time, I should just be buying, and I'm afraid of the market, I should be buying paid off rental real estate, right? Because if I buy a 6 cap or 7 cap rental property, and I just pay it off, and I'm just throwing darts at the wall, buying an average property in the local area and maybe do a little bit of work on it. That's going to produce a 7%, 7% tax advantaged cash flow, which is better than what I'm getting from the hard money notes, even though the interest rate is much higher. That's the beauty of real estate, is it's an inflation adjusted income stream for life, right? Once it's deleveraged, right? There's all this math about why leverage compounds returns and drives things up and forward, of course. And that's a really powerful and beautiful thing about investing in real estate. But paid off real estate also has that wonderful simplicity of, by definition, it's tied to the CPI. It's a third of the CPI, housing costs. So over a 50-year period, you can be pretty sure you're going to get an inflation-adjusted preservation of your capital if you do a reasonable job of maintaining the property, and an inflation-adjusted income stream. Those are all the things that go through my mind when forming this ever-evolving and ever slowly changing philosophy. But right now, if you ask me what do I want, for my portfolio to look like, I'd say like an end-state portfolio looks like a third, private businesses that I can have some control over and really drive outsized or chase those outsized returns. 2 is the real estate, lightly leveraged, that provides really stable and predictable income and wealth preservation. And the 3rd is the index fund portfolio. So I would literally bucket like that, whatever, regardless of what the dollar amount was at the inside, say that portfolio, that's what would appeal to me and give me the most optionality in life.
Love that. What about your given your desire to obviously have low leverage, some of that, what's your buying strategy? Or do you want to continue buying small rentals, small multifamily? How often? How do you want to grow that and to keep this, obviously safe and secure method, which I really like, by the way. But how fast do you want to go?
Yeah, I think that Warren Buffett and Charlie Munger have a really good framework around like, imagine you have a punch card with 20 holes in it, right? And that's the total amount of lifetime investments that you'll be able to make. And that's kind of how I'm treating real estate, right? So I will continue buying real estate, a property every 12 to 18 months, probably for the next 20 years in there, but I won't buy like 1,000 homes. Like if I ever get that lucky, I'll buy like a bigger property each time.
And just speak to, how you feel about leverage across that portfolio. Do you always want to have leverage? Or are you going to do refi so you can buy more deals like everybody talks about? Or is it as quickly as I can pay these down and have no debt type of philosophy?
I'm not paying down the mortgages on my existing portfolio. With the next purchase, I'll probably put down a lot more cash. I may take out some leverage on it, like 30% leverage. Right now, depending on what you believe in the real estate market, you have to have a pretty aggressive set of assumptions around appreciation and rent growth to leverage at 8% or 7% interest rate debt, right? 8% is probably more realistic for what I'm thinking about purchasing. So, I think that lighter leverage, has certain advantages. It does compound the returns a little bit, and it allows me to use the cash flow to pay it off. I'm not deleveraging my existing. I'm in what I've talked to a lot of real estate investors out there, and in the residential space in particular, everybody's feeling stuck. They're locked in. You have this 3% interest rate, 4% interest rate debt on your portfolio. It's exactly what I have on my duplexes, triplexes, and quadplexes. I'm not going to pay that off. But when you get an 8% interest rate new debt, really compelling case to pay that off. If you're like me and your full-time effort isn't in a real estate business, right? Real estate is not my business. My business is I work at BiggerPockets, right? And we help real estate investors. But if I actually was in real estate, I'd be doing a lot more work on them and levering it a lot more. Because I'd be able to drive better returns there. But because I'm trying to get this to be semi-passive, outsourcing property management, those types of things, an 8% guaranteed return on new debt is pretty tempting just to chunk it out and pay it off.
Yeah. Yeah. I know the listeners, as we mentioned in the beginning, are wondering, hey, what about investing passively, right? I know you have been doing a lot of research around syndication. I want us to obviously spend some time there, and because a lot of the listeners are passive investors, and a lot of them are active as well. Are trying to grow a really commercial real estate business, and I know you have a lot of insight there on this current market of commercial real estate, and want to dive in there. But maybe start with your investments passively in syndications, haven't, some thoughts there, and let's jump in.
Yeah. So, I'll just kind of relate my story with passive investing, which is, I took a small chunk of my portfolio, less than, I think, 3 to 5% of my wealth, and put it into 2 different syndication deals, with a syndicator I knew, and actually who I had met through BiggerPockets and had written for our blog and been involved. And this was in highly levered deals in Phoenix. I think they were purchased at a 3 cap. And they were, nice, B plus, A minus properties being repositioned to A plus. The syndicator has executed the plan, did a great job, right? Clear reporting every single month. Wonderful actor, high integrity. I have no complaints about their activity set in there. That said, the market does not really care about how great a job the syndicator has done. We're likely flushed on this deal. One of the deals, or both the deals, one of the deals is, I think, going to be valued at a 5 cap, and it was purchased with, I think, 35% equity. So you can do the math there. NOI has been relatively flattish during that period, again, due to Herculean efforts on the part of the syndicator, driving rents up and executing the plan almost to perfection, from my view. But rents just have been getting clobbered by the influx of supply coming on, and insurance and taxes spiking are offsetting those rent increases to a certain degree. So that flushes your equity at that point. So capital calls are coming inbound, and I got to make decisions about whether to participate in both of them on both of these properties. The other property's in a little bit better shape. We've only lost 80 to 85%. I believe, of the equity that was invested, not 100% if we were to sell today. So this is a disaster, right, on both of these properties. And I think a lot of people out there who have invested in the space are in a similar position to me, right? I don't know a lot. I've met a lot of passive investors out there. I've met almost no one who puts in more than about 25% of their wealth, and very few put more than 10 to 15% of their wealth into these types of deals. Basically, that's what I did. I put in a small amount with the syndicator and then upped it after a successful exit in one of the first deals in there, and just replaced it and added a little bit more cash because I was excited about the offering. And, I'm supposed to be good at this, right? I run BiggerPockets. I spent 10 years investing. I've probably spent 10,000 hours learning about real estate, in addition to however many thousands of more hours I spent engaging with people on the forums. But I still got sucked in by the FOMO, right? I mean, these are incredible IRRs people were putting up when they were exiting deals in 2021 and 2020, right? And, it's hard to watch like my steady Eddie approach with duplexes get just completely outstripped by these guys who are raising hundreds of millions, in some cases, billions of dollars in capital, buying properties at huge leverage and exiting them at 30% IRR and then taking 20, 30% of the carried interest. And so I think a lot of people, are probably can empathize with that situation in there. And it's like a painful lesson, but it's not one that's going to completely devastate or disrupt my lifestyle from that. And hopefully that's what a lot of people are in there for. When I think about what's happened here, right, I spent a lot of time ruminating on this from a macro perspective when interest rates started rising. And, I think 2024, in 2023 and 2024 have been this disaster for the commercial real estate sector, and in particular, multifamily, because you've got almost a perfect storm coming together to really destroy value in the space, right? So first, we can talk about supply. We've got 500,000 multifamily units being delivered in 2024 with about 1.2 million under construction. So 500,000 multifamily deliveries is the most ever for the United States of America by a good bit in there. And that's not going to really abate in 2025. It'll come down a little bit less. But I was shocked in 2023 when it was the most ever. And I was even more shocked when it was 2024. I'm getting a little bit more sophisticated understanding the supply pipeline here. But that's, they talk about housing affordability and how expensive everything is and all that kind of stuff. Well, housing costs, at least rents, are trailing inflation the last couple of years. Multifamily developers in this country are doing everything they can, perhaps at their own expense, to offset the affordability crisis. And it is working. Rents are down, right? Austin, Texas is touted as this great market with tons of inbound interest. And in a lot of ways, they're doing a lot of things right and attracting a lot of new business to that town. But when you increase supply by 10% in multifamily units alone, I don't care how great your city is. Rents are coming down, and they're probably going to stay down for some time. And that A-class stuff at the top of the market pushes everything down, and it hurts the previous A-class stuff the most, right? The stuff that was recently the top of the market. Well, now those tenants who are willing to pay the most can go to the brand new building right down the street that's offering incredible concessions. And this is happening all over the place. You can look outside your window in Denver, Colorado, and see it happening. Phoenix is pretty bad. The Carolinas are seeing a lot of this. Florida, Texas, among the worst. So that's just supply. Demand, I think, is also a wild card, right? Because there's migration patterns that happened in COVID and in the aftermath that are starting to change. And I'll use one without getting too politically charged here, but I'll use like Florida or Texas here as an example, right? Lots of business-friendly policies stole a lot of people and jobs from places like California and there. But I think that there's a limit to how much that works. And when you move from a place like San Diego or Orange County, California to Texas, you realize, oh, San Diego and Orange County, pretty nice from a weather standpoint, quality of life perspective. A little different from the June weather, July weather that you're going to be seeing when you hear this in Texas. And the politics are so different that I think some people that may not be willing to put up with them in a place like Texas if they've moved from a place like California previously with certain types of things. So I think that people are betting on trends that started that may not continue in some of these markets. So that's the demand side. I think there's problems there. The next piece is going to be taxes and insurance. Nobody's having a pity party on a syndicated private equity landlord who got in over their skis buying a multifamily apartment complex that's now worth 30% less. And it is it is the easy button to say, oh, we're not gonna lower your property taxes. If anything, we're gonna raise them in the context of the current environment. And then of course, everybody's, I think, aware who's listening to this of the skyrocketing insurance costs in all of Florida and certain parts of Texas, like Houston. So those are hammering, and those are just the worst possible levers, because everyone can, tell a story where they believe in long-term rent growth, right? 10 years, rents are going to grow, right? Not arguing with that. But once your insurance policy increases by 100%, it's never coming back down. Right. So it just gets taken straight out of your NOI, which completely disrupts your value. And then last, we have the interest rate. issue here. So the interest rate issue is, I'll just remind people of the obvious here with the interest rate issue. But when the federal funds rate is 5.5, 5.25, and you can put your money and get a 5.25 yield in your savings account, why would you buy a super volatile, 4 or 5 cap apartment complex in a place that has all of these question marks that I just posed, instead of just sticking it in your savings account, or sticking it in money market, or doing the lending that I just described? It's just so easy to generate a higher yield than what you can get in these commercial properties. That I think you're seeing this pain and pressure of jacking up cap rates. Right now, we have an impasse because the sellers of yesterday, like my syndicator, don't want to realize defeat and say, oh, yeah, we've actually now lost all of the equity. It's gone forever. Like, at least in this current period, if you're not forced to sell, you can pretend or hope that value will come back as rents rise. But with every passing month, the dials turn a little bit harder, the screws crank a little bit harder on these syndicators, and you're forcing that reckoning. You're marching a little bit closer to that reckoning that I think is around the corner for many of these folks. So it's a pretty dire situation. I think that you're seeing an enormous amount of generational wealth being wiped out in this environment, and I'm very bearish, at least for the next 18 months. I think that the federal funds, there's all this like hope that the federal funds rate is going to get lowered, right? Well, the 10-year treasury, this is the yield curve. It's really important for the commercial real estate space. If you don't understand what I'm talking about and it's in a relationship, probably shouldn't be investing in multifamily real estate here. But the yield curve is inverted. So the 10 years trading at 75 bips, give or take, lower than the overnight rate. The 10-year in a normalized environment trades at 150 basis point positive spread to that federal funds rate. So at 5.25, the 10 years should be at, if the yield curve was normalized, 6.75%. Your multifamily borrowing rate is going to be another 100 basis point spread, 100 to 150 on top of that. So that puts your debt costs for a Freddie Mac loan at 7.5. And then your cap rates usually traded at another 150 basis point spread to that. That puts your cap rates at 8 or 9. Do I think it's going to go all the way there? No. But for the 10-year treasury to stay where it is, the Federal Reserve has to lower the overnight rate 10 times to about 3.25, 3 to 3.25. And if you think about the pain and devastation that is going to hit the United States economy for the Federal Reserve to lower rates 10 times and in a hurry, that is also not a good situation for your equity in your multifamily real estate syndication deal or any other commercial real estate deal. So I think there's a ton of pain to come. And people who think that rates are going to go down in the multifamily space are, in my opinion, out of their mind. That is not a bet I'm going to take or willing to make here. Rates are going to stay flat or rise in multifamily and commercial real estate for some time to come, unless we are hit with a devastation, recession or depression, where you can actually see unemployment spike to a rate that forces the Fed's hand. And again, that is not a happy scene. Now, that's going to be different in the residential borrowing space because there are slightly different rules about how mortgage rates work and their relationship to the 10-year. But in the Freddie Mac and GSE space, I think there's a lot of pain on the horizon. So for all those reasons, I'm a super big bear on this space. I think 2024 is going to be terrible. First half of 2025 is going to be terrible, but there will be light at the end of the tunnel in the next couple of years as the supply abates. I think you're going to see rents skyrocket because, again, I don't think rates are coming down. And the alternative to renting, which is buying a house, is so much more expensive that you will see the demand increase for rent. And again, when supply abates, I think you're going to see rents begin to surge. But that's the game you got to play here. And I think that in the meantime, it's really painful for the multifamily operator.
Yeah, that surge is not going to come fast enough, right, for the current deals that are in trouble, right? I mean, ultimately, you were talking about like over the next, you see a lot of pain over the next 6, 12 months. Do you see that as being a lot of buying opportunities, though?
So that's the question I keep asking myself, right? Is that a buying opportunity? And I think not yet. I think I think what is a buying opportunity? I mean, look, if you buy in all cash and you forget leverage, it's better to buy now than it was a few years ago, right? And that 6% cap rate, I think there will be people buying that. But when you're buying with 7% debt on that 6% cap rate with a negative leverage, I mean, you got to be all in on appreciation and rent growth.
Yeah.
And I don't think very many people are going to take that bet. I don't think the pain abates until at the least the cap rates are higher than the interest rates in the space as an asset class generally, and in certain regions specifically. I think that word region is the key word here, right? Like, sure, maybe in your region or a region, it's already a buying opportunity. And in other regions, it won't be until 2026, 2027. You have to become an expert in those areas to really make that determination.
I know that a lot of the listeners are also receiving capital calls, just like you're talking about. And so, to know what everything you just said in the last few minutes, right, about commercial real estate and the current market and whatnot, but also knowing that you're a passive investor and obviously not had the best experience on a couple of projects here. Can you, talk about just a minute or two, though, about how you're assessing if you're going to participate or not, if you're able?
Yeah. So, there's a big discussion on the BiggerPockets forums, right? And there's a lot of good answers out there. First rule is, if you didn't know what you're doing going into the deal and you still don't know what you're doing today, don't participate in the capital call, right? Don't invest in something you don't understand. So I think that's an easy button there, like for someone listening. In the case of one of my deals, I think the thing was bought for like $77 million. And I think its market value today is like 44. And the debt on it's like 48. So, and the capital call is to stave off that one. So that's the dilemma that I'm facing here. And if I participate in the capital, so I almost look at it like this: like, if I participate in the capital call on a deal that's worth 44 with 48 in debt, I'm like waiting a long time for that deal. I'm buying it with 110% leverage, right? I could turn around and instead put that capital into buying that deal for $44 million with a new 60-40 debt to equity ratio in a new syndication. To me, I mean, that's just so much more compelling than participating in the capital call in that particular deal. But that's not the only consideration. The other consideration is I actually think that the syndicator is pretty good at what they do. I think that they got caught buying at the top of the market, but executed their plan. And this is not like some of the syndicators out there are ridiculous. They're just ridiculous. Like, they go out there, they raise billions of dollars in assets, and they have like a new side project every week that they're bragging about on social media. Oh, I spend so little time running my syndication, and I don't actually, I'm not actually involved in it or whatever. Oh, and like this deal is getting a capital call. I'm not going to participate in it, but I'm raising my new fund over here. Like, some people are like, it's that painful in the space. And some of these guys were on like guests on the BiggerPockets podcast in the past too. I won't call them out specifically here, but like, I hate that. It just grinds my gears so badly that people can mistreat their investors like that. Like, it's one thing to lose, but it's another to just like give up on your current investors and basically give them a, proverbial middle finger by going off and doing your next project while you're supposed to be stewarding your existing investor capital. And I know that people listening to this are going to hear this and be just as mad as me at their syndicator who's doing this to them right now. And my guy is not doing this to me. And like, that's another component for this is like, I think that this guy's a winner. I think that over 20 years, he delivers some really good returns. And so all of those things are going into my mind as I'm like weighing whether to participate in these capital calls, right? And so it's like, I don't know. Like, I think it's like you do all this analysis, and then when the call comes, you're like, yes or no. Do I put it up?
I do really appreciate, though, how obviously this operator stood out to you in a good way, even though obviously the deal's not where anybody wants it to be. And there's obvious frustration there, no doubt about it, and rightfully so. However, I just appreciate, you're even speaking kindly about the operator, right? And that he's obviously performed in ways that have been meaningful to you. And I I unfortunately don't believe that's going to be the majority of operators that are struggling right now, right?
I think it's like a wheel, right? Like it's like, let's play a game. Is your syndicator unlucky? Are they a fraudster? Are they grossly negligent? Or were they just like super naive and inexperienced? And it's like, and like one of the things that I think is really interesting about this market is like there's a few people who just like played it perfectly, like got out at the right time, been sitting on their hands the last 2 years and will jump back in, and they're gonna make a killing, right? But that's not a sustainable way to play any business, right? Like that's just like perfect market timing. And like you're gonna get a few lucky ducks and maybe one or two geniuses that are able to actually do that. I think what matters more is like nobody can win for 40 years in a row, producing double digit plus IRRs for investors in a space like this. They're going to have some winners, they're going to have some losers. And like good in the context of losing is a really kind of, it's like an integrity thing for me, almost in the space. And like, I want to see who those people are. Good in the context of losing is exactly what my syndicator is doing, right? Like he's losing. It sucks. All these like paydays that he was hoping for, that we were hoping for, but he is there. He is in Phoenix. He's on site at the properties. He is trying his best. He produces financial reports that are super detailed each month and tells me like it is, and then calls up all the investors personally to ask for that capital when it's in there, owning the situation. That's good. Total respect. Other people, again, not so much. And that's what really makes me, as CEO of BiggerPockets, proud to be invested with this guy in spite of our loss, and ashamed that people who came on our platform and raised capital are behaving so badly in direct opposition to what my guy's doing.
Yeah, I think it's interesting the seat you're in too. You get to see that firsthand, right? All the capital raisers, right? Quote, people who are doing exactly what you talked about earlier, which is so frustrating, and really giving the middle finger to some investors who have trusted them, and then raising capital over here for the next opportunity, right?
Oh, and it's like even worse. It's even worse when they like some of them are like, "Oh, look at us with our track record of 30+% IRR." It's like, dude, you haven't exited a deal in like 3 years. Oh, you just had 2 capital calls. Like, what are you doing with your ad here over on this one, raising more capital on this? It's, you can tell I have some feelings about the space here.
Well, rightfully so, and again, that's why I'm grateful to glean from it, because you have that seat where you're seeing all this from so many different angles. So, does this, actually, I just want even the operators, even newer operators are listening, to think through this too. Like hard times are going to come, right? And it's you talk about this 40-year career, somebody that there's every deal can't be amazing. It's unfortunate, right? Every deal can't be amazing. But man, we just want to operate with the utmost integrity in the hard times as well, right? And I just appreciate how it seems like this operator has done that. And I just want the listeners to think through that. Even the passive investors who are looking at deals right now are operators, right? And thinking through, man, is this operator going to operate that way, or have they in the past during hard times?
So I think that's the tell of the industry right now. All this junk has been exposed by the receding tide here. Like we see there's a lot of folks out there who like would pay $50,000 for some tribe or mentorship or whatever. And what they would do is they would literally like the tribe would tell them, stick up a landing page. It talks about how great multifamily investing is. And then what you do is you go and fish for people. Sometimes on BiggerPockets, we kick them out whenever we find these people, or in these other places. And then when you place the money in one of your fellow tribe members' deals, who also is brand new and has no idea what they're doing, you get a 10% placement fee for that stuff. All this stuff was like went undisclosed, and this pain is like, I don't know. There's tons of this going on right now in the space, and it's the pain of the losses and the value destruction that's going on here, I think, is going to have the silver lining of really washing out a lot of these people that are either taking advantage of people or so gullible that they got sucked in and were taken advantage of.
Speak to maybe some ways that the passive investors that are listening could even use the BiggerPockets platform to guard against some of these things, right? Or to figure out operators that are integrous, like the one, that you partnered with, or, maybe that's the path they're still wanting to go. They don't want to buy their own small multis, like you're building wealth doing. They do want to be passive and invest in projects like this, but how do they maybe, just at a high level or even detailed, how they can use BP to guard against some of this and learn, right, about different operators and just so they can be better prepared?
Yeah. So I think that it's going to be really hard, right? I tried to answer this question. We actually interviewed on the BiggerPockets Money podcast, which is a personal finance podcast that I host as part of the BiggerPockets network. We had a convicted fraudster who ran a Ponzi scheme for 7 years on the show. And I think talking to this guy, what highlighted was like he showed his financial statements in great detail to CPAs, accountants, sophisticated investors, and he fooled them for like 7 or 8 years. And so, like, I don't know how, like, I'm trying to frame how I can answer this question about how to, like, the first part of it is you'll never know, right? You'll never be fully sure when you give your money to somebody that they're not going to do any of these things. And you have to go into like a space like the passive investing and syndication world, knowing like a couple of things. One, you are giving control of your money to somebody else, and you have to, like, you're just trusting them. And no matter how great they are or how wonderful they are, they could have somebody low integrity working for them. They could get hit by a bus. Things happen with that. You can never put all of your eggs in one basket that is controlled by somebody else, by one individual or one group there. Even if they are fantastic, even if they're, they all claim to be, but even if they actually are that next Warren Buffett out there. So that's like, I think the first thing here is that there always has to be a little bit of skepticism. And then the second thing I think that one needs to do if they want to get into this space, is realize, like, what am I doing this for? Like, this is an inefficient market, right? If you just spread your bets around with 40 syndicators and the inverse of that in different regions, you're just going to do worse than you would if you went in a passive index fund, because these guys charge super high fees. Like when someone buys a $100 million apartment complex, many syndicators will charge a 2.5% acquisition fee for buying the thing. They'll charge a 2.5% disposition fee for selling the thing, a 1% to 2% refinance fee, and they'll charge a percentage of rents for managing the thing. Plus, they'll get carried interest. So you're already in the hole on an average perspective. So what you're betting on is your ability to get a different or find those kind of outlier deals over time that can offset the deck that is a little bit, I think, stacked against you. And I think it's still a worthwhile exercise. Like, I'm not going to give up on the syndication and passive investing world entirely, but again, it will not be more than like 10, 15, maybe up to 25% of my net worth long term. But you want to make a few concentrated bets, I think, is the lesson that I'm learning from this, in a couple of syndicators where you think they actually have sustainable advantage. So that brings me to the next point of, I think, it doesn't make sense to me to give my money then to a syndicator who is then going to diversify in a fund across 20 different markets. I want them to be the expert in Atlanta. I don't want them to have like one dabble in Atlanta, one in Houston, one in Seattle, one in the Midwest, one over here. Like, you can't be an expert in all those markets. So one example, one syndicator, I won't name them here because I won't name bad or good personally, because I don't want to bring that liability on BiggerPockets here. But one guy that's good, this is a guy who's been around for 10 years, investing in just one region in Columbus or Cincinnati, Ohio, one of those towns, and has a couple hundred units, like $100 million in assets under management, charges reasonable fees, lives there, is on site at those properties. Every single one of the complexes that he owns looks like it's exactly the same. It's so boring, so consistent. So that's the type of person that I'm going to be wanting to invest with. Like the guy that I invest with in Phoenix, just the same type of B+, A- stuff in the Phoenix and surrounding area. It's all he does, lives right there on site, knows the operators, can go in there and see and smell and touch and feel the properties, right? Like those are the things that I feel like give the investor a good chance for outsized returns. Although, what do I know? Because I got flushed on my 2 deals, of course, there. But those are the hypotheses that I come into my investing career with, right? I think the fee structure is important. How do you think about, and I don't know if there's like a rule of thumb or like a specifics you can get there, but I think there are theories you can bring. I think that you want the syndicator not to be worrying about their mortgage payment during the hold period. So they need to have enough income coming from the property or the fees so that they're not trying to figure out their side gig while they're managing your money. That's their full-time job. But you don't want them buying their mountain or beach house just because they bought the asset. You want them to buy that after they've returned your capital and some return to you. So I think that's the theme that you want to be exploring with the deals that you're doing, and the fees that you're paying to the syndicator. And then I think from there, you don't have to agree with my construct. That's my the bones of what a good syndication and a good syndicator look like. And then I think from there, it's reps. How do you just get in front of dozens or hundreds of these things over time, right? Just like you would if you were buying a duplex or another investment, you would analyze many dozens or many hundreds of them before committing capital. And I think that's the framework. And so to solve for that, BiggerPockets is going to be introducing a new brand called Passive Pockets, which will launch in September. I love Passive Pockets. We probably won't refer to it by its abbreviated PP initials there, but Passive Pockets is a brand that is for this accredited investor who maybe has some real estate background, but is not trying to buy their seventh duplex anymore. Maybe they're going to be putting that extra capital to work again in their index fund or their investment portfolios, but also in the syndication space, which should, to your point, begin presenting opportunities in the near future, maybe the next 6 months, maybe the next year and a half, and to evaluate the offerings provided by current offerings provided by syndicators in the space one by one. And if we're successful, we'll be able to, bring some people that are much more skilled at evaluating these syndicators than I am to the table in the various asset classes, and to beat up the deals and say, here's what I like, here's what I don't like, here's what I was hoping to see, here's what I don't. There's enough good here where, there's some good stuff. We won't officially endorse or recommend deals for liability, but we believe we can give people enough reps to make quality decisions over time. And hopefully, if we're able to attract enough scale, one of the other things I'm hopeful of is if LPs on Passive Pockets want to commit enough capital, like let's say like $5-10 million to a deal, well, that's a big enough chunk where each individual person committing $50,000 wouldn't really get the attention of the GP. They get a phone call and a nice thing, but they wouldn't get any actual concessions. But if we can get $10 million in aggregated capital into a deal, maybe then that capital can pool together and they can hire a lawyer and they can hire some experts to come in there and negotiate the terms of the PPM to give a little bit more, make it a little less lopsided from a power dynamic distribution perspective from the GP to the LP. So those are the things we're noodling on. Again, I'm super excited and passionate about this. And of course, we'll also offer opportunity for people to review the syndicators, and we won't allow them to just mass blast their social media followers to give them 5-star reviews. We'll kick all that crap out and have legitimate contributors to that community be the ones reviewing syndicators.
Love that, Scott. And I just appreciate the level of detail around the operator and how you feel, man, these things are what's important. Love the focus in the market, even, it doesn't have to be somebody with $1 billion in assets either. Right. And it sounds like preferably not, right. They have that 100 million in this one market. They live there. They know these properties so well. Go ahead.
And that's like another one too. Like all these syndicators are like, oh yeah, look at the track record of the syndicator. Well, like all of them point to a track record that was like from 2010 to 2021 or whatever. And I also think someone who's doing their very first syndication in like a modest 20, 30, 50 unit apartment complex where they're raising $3 to $5 million, like that could be a great return on someone's first deal. And they might charge different fees or much lower fees or, have a lot more hustle in them than someone who's been doing it for 30 years or maybe 15 years and has got their clock cleaned in the last turnaround and is looking for that, the next wave here. But so I just think it's so hard to answer your question about like, what is the best way to invest in the space?
Yeah, for sure. And it's not an easy answer, but I love all the detail that you gave. But what about the deal itself? Any, you found that amazing operator, all the details that you laid out, already. What are some of the things you would describe about this type of deal is what I'm investing in now, or maybe it's a deal with no debt, or it's whatever. What are some of the details there? That's going to be that next investment, passive investment for you, given you will make another one.
Yeah, well, I think I'm going to stick with what I know, which is going to be multifamily. But I think that's where this again gets really interesting. I spent all this time talking about the jockey and not the horse, right? The jockey being the syndicator and the horse being the deal. You've already heard my macro theory here. I prefer to invest in markets that I know and understand. So I'll probably be looking here in Denver. A deal will have to be purchased using it at a cap rate that is lower than the debt financing used to purchase it, which is just not happening in Denver right now, but I believe will happen by the end of the year or early 2025. And if I can find that in a property that I understand reasonably well and that's reasonably lightly leveraged, I'll be interested. I think that the person putting that deal together will not show the highest IRR, which is something that I think a lot of passive investors chase. They're like, oh, that model has the highest IRR. But I'll be looking for a deal. Again, it comes back to the syndicator because it's how the deal is underwritten. A lot of these deals project selling the deal. Like the term exit cap rate is something that I think probably half the people listening to this podcast may not know or be familiar with, but is an absolutely critical. Like if you don't understand that term, you cannot be investing in this space because it's such a critical assumption. If you're buying at a 6 cap and your operator is assuming they're going to sell it at a 5 cap, they're going to show you a wonderful IRR on this piece of paper, and you're going to be really impressed. I think you're going to make a lot of money. But what I want to see is the operator buying at a 6 cap and assuming they're going to sell it at 6.5 or 6.75, or that have done that sensitivity analysis. And the base case IRR that they're promoting is reasonably conservative, certainly not at a lower cap rate than what they're buying it at. So those are all things that are going to be in consideration. Everybody says they've got a value add deal. I've seen a couple of deals in the past where dude's like, hey, I'm going to buy this apartment complex and going to redo the landscaping. And that's going to drive rents up $400. And their budget for the rehab was like $3.5 million, and $3 million were going to the grounds. No way, right? That's not how the life works. Right? There needs to be a major remodel to the unit, and the landscaping has to be, pass the sniff test here. So there's a lot of those things that are very hard for me to make a judgment call on a property in North Carolina. Not ever going to North Carolina. I mean, been there twice in my life or whatever, and living in Denver. But in Denver, if I can go there and see it, that's going to be much more appealing to me. And one of the lessons I've learned is like, okay, I can see this business plan, and I can see how the numbers here are likely to translate to what they're talking about in this offer minimum. That's the kind of deal I want to get involved in on a go-forward basis.
Well, we're going to have to transition to a few final questions, Scott. And I'm just, I love your, just the passion behind this as well. And I think it's going to help a lot of passive investors that are listening and others, and even the operators that are listening. I hope it kind of checks them a little bit. Man, think about how they're performing or the deals they're looking at, and even how we're marketing to investors, right?
This is not me trashing operators. Like, again,
sure.
you say a bad word about my guy, right?
Right.
I'm in there. I think we just got caught up buying at the top, and he's going to have a super successful career and someone I'm proud to invest with. But how you lose matters in a big way. It's not just winning or losing. That's where I feel almost a little bit of a duty to go after some people who are treating their investors very poorly. And some of these guys send threatening messages to BiggerPockets members when they post ill about them in the forums. And guess what? That's something that I remember, right? When those things happen. Like, why aren't you there discussing your business and being honest with your investors?
Man, a lot to learn on BiggerPockets for sure. But I love your statement though. How you lose matters. That definitely defines the man, right? Not just in the high times, but the low times, challenging times. That's when the real heart comes out for sure. So, well, Scott, transitioning just a little bit. I know your diligence in just investing and growing your own personal portfolio and the frugality, I mean, that you have had, which we didn't get into a whole lot, but I just encourage listeners to even read his book, Set for Life. And I know I want try to get my, some of my family members to read it as well, because I feel like there's a lot of lessons there. Even, your diligence in house hacking for 10 years. I want to get in one question there. Speak to your really your spouse's outlook on, man, your desire to be that frugal, to house hack, let's say early on. Now it's easier to probably see some of that, right, come about. But what about early on, and maybe even the dating to getting married, when you're having those conversations about, man, I want to be this frugal. I'm not going to go buy the beach house. This is the plan I see. How did you kind of incorporate your wife into this in a way that maybe she's motivated about it too?
Yeah. So my wife, when she moved in with me, probably a couple years after we started dating, she moved into one of my duplexes, and we did not have a heater at the time because I was too cheap. I bought it in the spring, and I was like, I don't need the heater until the fall, right? For these things. So we lived in my rental properties. I've lived in 3 of my properties over the years, and we've been doing a goal setting exercise. I think is the best way to answer your question, together as a couple from the day we got married. So I'm this nerdy. I wrote a draft vision for us. I called it draft vision. Tip out there, right? If you want your spouse to have input and change things on this. And we said, okay, here's where we're going to live in 3 to 5 years. Here's what our lifestyle is going to look like. Here's what families, and it's a draft. It can change. We update it every single quarter on a date from there, but we align on the vision, and then we take steps every quarter to move towards that. And because of that, I think it was very easy to get alignment of, yeah, we're going to house hack for the next several years. And here's why. That's going to create this kind of optionality. And that allowed us in the last year to buy, it was written down 3 years ago what our house would be, the mountains that we would see looking out our window every day when we woke up or went to bed. And so this house is exactly what we described in this vision statement. And we updated it again from our front porch and said, okay, here's where we want to be in the next 3 to 5 years. And that kind of fuels the goal setting and activities that we do on a regular cadence here. So I'm sure somebody has, trademarked or come up with a much better system for this. This is just a Word document that we put together. We do gratitudes, and then we read through the vision from last quarter, and we make a few tweaks if anything's evolved, because it's always moving. It's never a static document. And then we look back, and it's pretty wild to see how so many things, not all of it, so many of them have come to fruition there. So that's the way we get alignment, and that spits out most of the other outputs in our lifestyle. And it doesn't resolve all conflict or all those types of things, but it is a huge tool for making sure that we're on the same page for the biggest things that we want in our life.
That's incredible. I'm glad that came up. And, asking your future bride to not have a heater for a number of months. I mean, that's a pretty big test right there. It would be from
well, she asked me why I didn't have one, and that was my answer. And then a few days later, we got a furnace installed.
Okay.
Yeah, that wasn't really like a disagreement there. It was just
That's awesome though. And the listeners, man, I hope you listened to last week's episode. I actually did a solo show on actually habit 2 of the 7 habits of highly effective people, and it's begin with the end in mind. And that's exactly what you're doing, right? You're envisioning, right, what you want the future to look like, and so you're creating a path to get there. And I love how you incorporated, your bride in that as well. And I love calling it a draft. How you mentioned that, I think it's so important. Giving and not giving, but say, hey, I want your input right into this, and that it's going to change, and then the cadence of revisiting it quarterly. I think that is so wise. I have what I call a 100x roadmap on my wall, and it has 5 areas of impact that places in my life that I want to be highly intentional, and personal mission statement and family mission statement, and some of those things that it takes time, right, to think through those things. But man, without the target, or with no target, you're sure to hit it.
Well, then they've got to be documented and then reviewed regularly. So we have this and one other thing that I think is a big tip on this is this exercise, and I'm really annoying about it, I believe has to be for me, I feel the best in the morning after I've had a workout, really got a good sweat in, and then had a nice breakfast that's pretty healthy and a big cup of coffee. And once I've went around 10 o'clock, 10:30 in the morning, like it is right now, that's when I'm starting to feel my best. And that's the time to review the vision and set goals. not at 9 o'clock after a really hard day, because it totally changes the dynamic. So I'm really insistent on that. And I like to add a bonus of a really pretty view or some water or something nice that has happened there. I found all those things really help this a lot. Any version of the visioning or the exercises that you do around personal mission statements, I think all that's really a soft thing that makes a huge difference.
For sure. A couple other quick questions. What about some other just daily habits that you're disciplined about?
I have this tool that I use. It's I say it endearingly, with total respect and love for Mr. Darren Hardy out there, but it's kind of like a little cheesy self-help book called Living Your Best Year Ever. And I map out my week, and it has a good forcing function. It's very simple, but forces you to pick 3 of your biggest goals for the quarter. And they've got to be in different areas of life. Set them into monthly goals, set them into weekly goals. And so I translate that vision work I just did there into this workbook. I'm doing it 10 years, and I track my habits and those kinds of things that are related to it. So that's a grounding exercise. It takes me like 20, 30 minutes every Sunday night to plan out the next week and review the previous week. And I'm not perfect. I miss plenty of days, but I rarely miss a week. And so that keeps me from drifting off course to my goals for more than about a week. And there's so many little things that exercise does. I mean, so many things in my life that are major goals involve me sending an email. And if I don't send that email, I get set back a month or 2 weeks or whatever it is. And that function really makes sure that those get sent out and then those items get progressed. So that's another one that I really find powerful.
What's the number one thing that's contributed to your success?
I think it's, there's so many things that contributed, but the thing that I've stuck with as a process is this. It's this: set a vision, set goals that spit out from that vision, chunk them down into quarters, which works for me, and then review every single week, if not every single day. If I was great at it, I would be doing it every single day and knocking it out and have a near 100% completion rate. But I'm good. So I have a near 100% completion rate for my weeks.
And how do you like to give back?
How do I like to give back? I love what I'm doing at BiggerPockets in terms of, I think that capitalism is inherently unfair if you don't know the rules. And so we like to teach the rules. I've taught financial literacy off and on at various nonprofits in the Denver area. I found that you really got to find the people who want to improve their lives in order to get that message through. So that's been a journey. Found a really good nonprofit that does some good work on that front in the Denver area. And so I'm involved in that. And then, just try to be involved in the community in a general level, try to continuously meet investors in the local area and just chat with them and figure out what their problems are and figure out what's the right answer.
Scott, I'm grateful for your time and even the way you've given back to us today and sharing so much, and just your passion behind, even the syndication space specifically, but even just investing in general, your portfolio, what that looks like, and how you have laid this out. And I love the details that came out too about your wife and how you all do that. It's so important. The more and more we've done it, I just feel like, man, I wish I'd been doing this 10 years ago, right, with my spouse. And so just grateful again for your time in BiggerPockets, and encourage listeners to go there as well and create an account if you haven't, and be active in the forum. So Scott, is there a way they can follow you or learn more about you?
Yeah, you can. The best way to learn more about me or to connect with me is on BiggerPockets. You can find me there by searching me in the search bar and just send me a private message. I have an Instagram at Scott_Trench. I post, twice in a week, every 6 months. And I don't touch it again. So, that's probably not the best place to message me, but yeah, BiggerPockets. And you can always email me at scott@biggerpockets.com. Everyone assumes I'm super busy, but I'm never too busy to talk with people who want to chat about real estate and give me feedback, good or bad, about podcasts. So please do feel free to email me.
Awesome. That's a wrap, Scott. That's the end of the show. Thank you so much.